All right, let's talk about down payment. Jim Seacott here with Polaris Mortgage Planners at Axiom Mortgage Solutions. So the minimum down payment is 5%, whether that comes from your own resources, comes as a gift from an immediate family member, or is borrowed. So let's talk about coming from your own resources first. So your own resources, we got to go back typically 90 days, showing that you've had the money or you've been accumulating the money. It can be coming from your paycheck and saving up over time, selling something that you owned and showing proof that you owned it. So if we go back 90 days and you have deposits coming into your account, anything that's payroll is fine, but anything that's not payroll and it's significant, like over $1,000 of a deposit, we have to explain where that came from. Because a person could have opened up a new credit card and advanced money from that credit card, put it into their account within the last 30 days, and it wouldn't show up in a bureau, but now you have this money. So we got to show that that's not borrowed money hitting your account, because if it is borrowed money, it changes it to a borrowed down payment, which is in the industry typically called a flex down. So we got to go back 90 days, show all the deposits that aren't payroll, or explain what they are, where they came from, and any account that down payment came from all gets involved. So we could go back 90 days on every account that accumulates that down payment. So if you had 5,000 coming from one account, 3,000 from another, and 2,000 already in the main account, so 3 come in, 5 comes in, we have to go back on those two accounts that had the 3,000 and the 5,000 90 days plus the main account that you have 90 days. So that's 3 accounts going back 90 days, showing all the money coming in to the main one for the down payment, or all getting written from those. So if you can keep it all in one account for 90 days, that's the easiest way to qualify and prove the down payment. Let's talk about the flex down, the borrowed down payment. So if you borrow a down payment, it can be coming from like a personal loan, unsecured line of credit. We got to be able to show that you have access to that money, and also what that debt payment is on that money, because you got to be able to debt service that payment as well as the mortgage. You also have to have a pretty good credit score and be able to qualify with all of that. And you also have a higher default insurance fee. So your default insurance fee goes up a little bit too, so it's a little bit more costly. The other option is a gifted down payment. It has to be from an immediate family member, mother, father, brother, sister, son, daughter, can be grandparents in cases where they are gifting you the money. You don't have to pay it back. They're signing on a piece of paper saying that this is gifted, their relationship to you, and that you don't have to pay it back. And the lender will want to see that money deposited into your account, and it has to match what that gift letter says. And in some instances, they also want to see the gifter, their bank account, showing it leaving their bank account. If you want to avoid default insurance, so default insurance comes into play. Typically, you have to cover it if it's less than 20% down. So if you're putting less than 20% down, it's considered a high ratio purchase. And at that point, lenders have to have default insurance backing them. It's a government policy, but that cost is borne onto you. It's added to your mortgage. And there's certain tiers at 5% down, they tack back on in today's rate, so it's May 1st, 2020, they tack back on 4% onto your mortgage for the default insurance cost. If you put down 10%, they tack on 3.1%. At 15% down, they tack on 2.8%. And at 20%, they either aren't getting default insurance because they don't have to, or the lender will still get the insurance, but they'll back in insure. They'll insure it themselves and cover that cost. So, and that's in most cases. In some cases, they still want you to pay it, and we would have to have that discussion. So default insurance is, a lot of people know it as CMHC. That's the Crown Corporation, Canadian Housing Mortgage Corporation. That's one of the insurers. The other two are Genworth and Canada Guarantee. And lenders, some have access to all three. Some only have access to a couple of them. And sometimes they don't like the file, the application that we send. So the lenders, if they get declined from one, then they might go to one of the other insurers to make sure they're okay with it. And so not only are we trying to get the lender on board when we're doing a high ratio purchase, but also trying to get a lender on board as well, or a default insurer on board. So that's the gist of it for down payment. Have any questions, let me know. Jim Sika with Polaris Mortgage Planners at Axiom Mortgage Solutions. Have a good one.